Hello everyone. Mini Professor Olivier is back again. Are you ready for a new weekly analysis of financial markets? If you enjoyed this weekly video, please show me your support and like it below, you will make my day. So, let's start. In the past weeks, while traders were faced with relentless bad news on the pandemic, the economy, Brexit and the US political scene, they seemed happy to look through the gloom to the sunlit uplands beyond. Now that the end is perhaps in sight on at least some of those issues, markets are starting to focus instead on the unfinished business, the things that remain unfixed and problematical. So, counterintuitively, it is the rollout of the vaccine that looks like it might be the trigger for a market correction, while, throughout the past year, it has been the prospect of a vaccine-led reopening of the economy that has fueled a remarkable V-shaped recovery. As we've seen in recent weeks, old hands who have lived through booms and busts before are starting to warn that the current level of the market is unsustainable. Jeremy Grantham has talked of an epic bubble. Seth Klarman has noticed how investors are living under the impression that risk has simply vanished. Goldman Sachs has warned that a short-term correction is likely, even if it is quick to point out that this will probably be a buying opportunity for longer-term investors. Markets are riding a wave of unprecedented liquidity, with fiscal and monetary policy teaming up to provide the biggest boost to asset prices for 70 years or more, since they last worked together in the wake of the Second World War. There should be further news on the double act this week, as the Federal Reserve concludes a two-day rate-setting meeting on Wednesday. Absolute Strategy Research, a market analysis firm, has come up with a list of bubble indicators that it thinks make valid comparisons with the boom in Japanese equities in the 1980s, the dot-com bubble in the 1990s, and the commodities boom in the noughties. Common features include low interest rates, high share valuations, bullish retail traders, and accelerating share prices gains, as some of the hottest investments, think Tesla, turn left and head up the page in classic late bubble exponential rises. ASR says that 1 in 10 US stocks are now 40% above their 200-day moving averages. That is very rare. Only 4 times in the past 35 years has that been the case. The FT is today reporting another measure of excess from the Bespoke Investment Group, which it calls its ludicrous index. This is a measure of the number of companies listed in the U.S. which have more than doubled in price over just the past 3 months, and which are valued at more than 10 times their annual sales. At the moment, this index stands at 79 companies. Over the 10 years to last year's market collapse, the number was never higher than 13. But during the dot-com bubble, 20 years ago, it reached 120 companies. At the moment, whether or not we're in a bubble is still a balanced debate, because there are other traders who still think today's prices are justified both by the changing corporate environment, tech stocks are structurally more profitable than they used to be, and the policy backdrop, which looks like continuing to be very supportive for the foreseeable future. That's why Goldman Sachs, for example, says any short-term correction would be an opportunity to top up on investments. It thinks we are in the early stages of a long-term bull market, starting last March after the early pandemic market sell-off. It says the hope phase of the new cycle, when valuations rise sharply even as earnings are still falling, is now over. But it says the growth phase of the cycle, which can last much longer, fueled as it is by real gains in earnings, is just beginning. The threat to that thesis might be a significant deterioration in the pandemic backdrop, if new variants turn out to be more dangerous and more transmissible than the original outbreak of COVID-19. This week, the list of gloomy voices was added by hedge fund Element Capital, which warned that investors and policymakers are failing to understand how deeply the new variant of coronavirus will hit the European economy. It says analysts need to revisit their forecasts for economic growth, as the variant spreads and lockdowns extend for months beyond current estimates. At the moment, there is widespread acceptance that the UK and Europe, and maybe the US too, face a short-term technical recession in the final quarter of 2020, and first of 2021. But what if the economic slowdown extends into the second and third quarters too? Meanwhile, in some ways it is back to business as normal, while in others the world seems to have permanently changed in recent weeks. U.S. politics is a mixture of both. Joe Biden has hit the ground running, with a flurry of policy reversals and bold gestures. He rejoined the Paris Agreement on climate change on day one, and is pushing for a massive $1.9 trillion stimulus package, including checks for $1,400 to all adult Americans. The permanent change is represented by the sheer scale of what he is proposing, which traders have identified as the trigger for a big rotation back into cyclical, value investments. The business-as-usual part of the equation is Republican resistance to the stimulus proposals. The fragility of the Democrat majority in the Senate is going to be put to the test in the coming months. And finally, this week is extremely busy on the corporate front, as the U.S. earnings season gets into full swing. In focus this week are a string of high-profile technology stocks, with figures due from Apple, Facebook, and Tesla. Also in this spotlight will be a number of airlines and related stocks. Both EasyJet and Wizz Air are reporting, while we will also hear from Boeing. Demand for air travel has obviously been massively hard hit during the pandemic, but it requires an act of faith to expect this summer not to also be badly affected, unless lockdowns are reversed very soon. On the healthcare front, we will have results from Johnson & Johnson, Eli Lilly, and Abbott Laboratories. That's all for this week. I hope you found this markets update useful. Please don't forget to like it below, and you'll make my day. Thank you very much again. I wish you all an amazing week. Goodbye.